For many property investors, £10,000 per month is the absolute pinnacle of property investing. Yet without some kind of plan and goal to achieve that £10,000 per month, that's about as useful as saying I'm going to get ripped, get a six-pack, without some kind of diet plan, structure, and without even going to the gym. And at times when I've met experienced property investors, they've all said to me the same thing. They had a certain amount of capital that they were starting with, and they had a certain goal they wanted to achieve, and they worked their way back. They reversed engineered their plan. So that's exactly what we need to do when we're at the beginning of our journey. We need to set an ambitious goal, and then we need to reverse engineer property by property, year by year. And that's what we're going to do in today's video. So now moving over to the whiteboard, I've put up here our goal of £10,000 per month. And if we start off thinking about single let properties, because I think it's safe to say most of us watching this channel want to build a portfolio of single let properties. And I think it's a fair assumption to make that the majority of these properties will make £250 profit per month. Now that's good, to be quite frank, at the moment, because of course, as many of us know, the interest rates really have affected how much profit we can make from these properties. But back prior to the interest rate rises, we might have been looking to get nearer to that £300 per month, whereas now we're looking at, can we get £200? Can we get £250 per month? However, the trouble is that if our goal is to hit the £10,000 per month, this is going to take a total of 40 buy-to-lets, which is not only difficult to be able to, go on that many viewings, that many trips, make that many offers, negotiate that many deals, let's say, as well as funding that many deals, 40 different properties. But it's also difficult to manage that. You've now got 40 roofs that can go wrong. You've now got 40 kitchens to replace, 40 bathrooms you might need to replace, and overall just 40 sets of tenants that you've now got to manage. But maybe we should flip this just for a second and say, well, how many HMOs would this take to do? And now a HMO, a house of multiple occupation, might be a 3 or a 4 bedroom house that we reconfigure the layout to make it a 6 bedroom, rent those out room by room in order to generate a higher income. Now the income of that property might be £2,500 or £3,000. Once you take away the bills, the council tax and everything that you need to do to manage that property, we might now be looking at, let's say, £1,250 in profit per month. But in order to hit that £10,000 goal, we now only need 8 properties. So our ability to actually go out and find 8 houses is much more realistic than potentially 40. Another thing we could do is look at serviced accommodation. Now, serviced accommodation is not where we're renting a house out to a family, or it's not where we are renting a house out room by room, but instead now we are taking a house, taking the flat, and we are putting that on Airbnb, Booking.com, and we're running this as a short let. Whether that is to someone that's going on holiday, whether it's to a company, a corporate let, we're running this on a short-term basis for a higher profit or a higher rent, which in turn will allow for a higher profit. Now again, you might earn £2,500, but once you take away all the costs of running that, the costs of changing the bedding and the changeover of guests, we might, let's say, look at £1,000 profit. Someone will be watching this that does service accommodation and they'll tell me they earn a lot more than that. But let's, for the sake of this, say £1,000. Well, now all of a sudden, quick and easy maths, we only need 10 of these properties, again, to hit that £10,000. Now, as I've already alluded to in this video, we might not be looking to do those second strategies. We might be wanting to do single lets, but I think it's safe to say that in order to reduce the amount of properties we need to buy, we might further down the line consider doing some of these strategies. And in fact, you might not start out that way. You might build a foundation of buy-to-lets to start with, but then you might move on to the slightly more complex deals, not only to make it funner for yourself and more challenging, but obviously to generate more profit and reduce the amount of properties that you need to buy. We might split this up into 2 phases. We might say that phase one here is the first 5 years of investing. And we might go out and we might buy 10 buy-to-let properties. At that £250 per month, we now know that that is £2,500 once we've got 10 of those. So we might spend the first 10 years doing that, as I say, to build that foundation, to get our knowledge, our experience, and the foundation of our portfolio really solid. And then the second phase, phase number 2, the next 5 years of investing might be where we actually aim to go out and buy, let's say, 5 HMO properties, which at that same profit margin, which was £1,250, is now £6,250. And in the same time of doing that, we got so good at buying buy-to-lets in the first 5 years that now we've managed to buy 6 buy-to-lets along the way as well, because we've got the experience, we understand what we need to do, we've got the team set up to do the refurbs, we just understand inside out from doing 10 of them. We buy an additional 6 at the same time, which of course is going to give us £1,500 for 6 at £250 profit. And if we take the total of all of that, we've now hit our £10,250 in monthly profit. Now, for many of you that have just watched what I've done there with those maths, you might then say to me, 10 years is too long. I do not want to take 10 years to build up £10,000 in profit per month. Now, for some of you watching that last bit of the video, you might say, that's great, Justin, but I don't want to take 10 years to build £10,000 per month. In fact, the first 5 years of buying 10 buy-to-lets, I don't even want it to take that long. And in which case, if that is you, we need to reverse engineer that. We need to work out how can we shorten that time frame of purchasing that many properties. So if we take phase 1 of the last plan that we just drew out, that was 10 buy-to-lets. Now, if we're going to buy 10 buy-to-lets and we say that they are £100,000, then we need to do the maths on what is required to buy 10 buy-to-lets at £100,000. Now, in order to shorten this process, we need to get better at keeping money moving and recycling that money onto future deals. So at this point, I would recommend that you are now looking at the BRR strategy. It's got many other names, BRR or BRRR, BRRR, but basically this stands for buy, refurbish, refinance. We're going to buy a house at a slightly discounted price. We're going to inflate and push up that value through the adding value and the refurbishment, and then we're going to refinance at that higher price so we can unlock as much of that funds that we initially put into this deal. So we need to work out all the costs that are involved in order to do this, and then we can see how we can shorten that time frame. So if we take that £100,000 and we say, right, each of those £100,000 properties is going to require a £25,000 deposit, which is 25%. If we times that by 10, that's going to be £250,000 that we're going to have to find, we have to raise potentially in the future. We've also then got to think about how we're going to add the value to these properties. Well, we're going to do that through a refurb. Same again, maybe let's say that we're doing 2 or 3 bed terraced houses we're adding value to in the north. Well, now we've also got £250,000 worth of refurb costs that we've got to equate for. We've also got fees, which when I say fees, I mean like stamp duty, solicitors, any fee that we incur along the way, which usually is about 5% of the purchase price. For an investment property, it's like 3% for stamp duty, and then it's a couple of percent there for the other fees that you'll incur across the way. But of course, you know, if we say that for a £100,000 property at 5%, that's going to be about £5,000 worth of fees. Then we take that, we times that by 10, and I don't know what number that was there, 50,000. So now we know that our total money that we're going to have to put into this deal is going to be about £550,000. So we could say that's the equity that we're going to need to find and put into these deals. And then what we're going to do is we're going to pair that with debt from the bank. Now, if you think there's 10 properties at £100,000, the bank would give us a mortgage on each one or a bridging loan for 75%. It means that we're going to have to find, or we're going to get from the banks, the mortgage lenders, £750,000 worth of debt. And the total of these two combined is now it's 1.3 million. Now, for those of you that are following along closely, you'll suddenly think, well, how on earth am I going to find £550,000? In fact, how am I going to find 1.3 million? Well, the bank, the mortgages, you know, that side of it is actually fairly simple. If you've got deals and properties that are good quality homes, then this part won't be too difficult. It's the £550,000 which is difficult for those of us that have maybe got 30, 50 or £100,000 in the bank. How do we then get to 550? So this is where private finance comes in. For many businesses, when they're growing and expanding, they will go out to the market and they'll raise finance from private investors. And the same is for property businesses. If you can show people your success to date and you can show them what you've done with these other properties, these case studies, then you can say, look, invest in my deals, I will pay you a fixed percentage return. Now that might be borrowing 100,000, it might be returning a 6, an 8 or a 10% return in some instances. So if we then take that and apply this to the buy, refurbish, refinance process, this would be how it looks. So we've just walked through the part where we're looking to fund these deals. We're buying 10 houses at £100,000 and we're reverse engineering how much money we need. Now we're looking at the refinance part of that. So if we have 10 properties now that we've bought for £100,000, we've maybe spent 25 on them, and now we're having them revalued at £150,000. So now it's 10 properties at £150,000. So at this point, we're going to get new 75% mortgages. Now, if we do 75% of 150,000, the new values, and we times that by 10, that will give us £1,125,000. Now, we don't just get £1,125,000 into our pocket. Sadly, we've got to repay those two things I told you about earlier. First of all was that £550,000. That's the original deposits, it's the refurbs, it's the fees of buying that property. We've also got to repay that debt that we took out at the beginning, which was £750,000. So for the smart ones of you watching, you'll now put the maths together as we did earlier and realize that these two equate to 1.3 million, and yet we've only managed to unlock 1125. So there's currently a discrepancy of 175. So we need to find £175,000. Not only that, but if we actually said, well, in this scenario, we actually went out to the market and we borrowed that equity part as debt from an investor, from a private investor, as I've just mentioned, and perhaps we do this at a 6% rate. Well, now we're going to have to pay them back all these. Maybe it's more than one lender, maybe it's a multiple different private investors that give us this 550. We're going to have to pay them back a 6% over the next year that we do this deal. This will also equate to £33,000 in interest. So we're currently missing £175,000 in difference from the money we unlocked, and we've got to pay back £33,000 in interest rates. Put these together and we get £208,000. So now all of a sudden we've gone from needing £550,000 at the beginning to acquire 10 properties to now just needing £208,000. If we know how to efficiently buy houses, efficiently refurbish them, and work with private investors during that process, then we can dramatically reduce the amount of money that we need in order to do that. But also we can dramatically reduce that timeline, because now we don't have to try and find 550. Now we've got to find 208 of our own money. Now, if you're sitting watching this video today and for you raising private investor finance isn't something you're interested in or isn't something that you feel like you're able to do, there are two other routes and options for you. Number one is the obvious one, is increase your active income, whether that's through your own salary, whether it's through your own business, or whether it's through doing side hustles. You know, you might even start a business within the property space, but which is a cash flow heavy business, which might be deal sourcing and packaging, or it might be a rent-to-rent business. But whatever you decide to do, you need to increase your active income to a point in which you can work out how many deposits you need, and then you need to be able to save that quicker. The other alternative, or perhaps the favored one to private investor finance, is joint ventures. Perhaps you know a family member, a friend or a colleague, or perhaps even another investor that is very rich in terms of capital, but very time poor. And that's where you can come in. Say, look, I am not rich in terms of capital, but I am rich in terms of time, experience, and knowledge. If you pair them together, you can form a joint venture limited company. You can go out to the market and do a similar kind of thing. You can purchase those properties. But now we're no longer just capped at working with private finance. We could do private finance, active income, or joint venture partnerships. So if your goal is to hit £10,000 a month, don't just say it, reverse engineer it, plan it out, and map it so that you can decide how long it's going to take you. Is it going to be 20 years? Is it going to be 10 years? Is it going to be 5 years? As always, I hope you've enjoyed the video. Don't forget to subscribe, and I'll see you next time.